Hello, everybody. This is Rick Geiler with SilverSide Insurance Marketing, and I have on the line with us again today Tony Fiorillo, and we're going to go over a little bit of the highlights of the SilverSide AMS program, and then I'll get it over to Tony for some updates and some comments on how we're going as we're moving forward here. So, for those of you not familiar with how the program works, you work with SilverSide on the fixed side, and SilverSide is a full-service life and annuity shop. We have a number of product offerings. We have design help, branding, a number of things, and we work with our agents on life, annuities, single premium life, all the things on the fixed side. Then you partner up with AMS Asset Management Strategies. That's Tony Fiorillo's shop. And you don't necessarily need a securities license to take part in this program. You can collect an ongoing referral fee from your clients on both managed assets and assets in 401k and 403bs. Tony can document an excellent track record with AMS, and he has an extremely high client retention rate. Now, one of the things that comes up when we describe this program to folks is the actual mechanism on how it works. So I'm going to get that over to Tony on how the solicitation agreement works, some of the common questions he gets, and how he approaches the whole thing. So, Tony, are you with us here?
I am. Thanks, Rick. Yeah. Just to touch on the slide that you've got pulled up there, in the conversations that we have with agents, we still find people that are surprised that this program is available, and I kind of like to address that a little bit. Keep in mind, some of these agents are getting mixed information about these programs because there are many states that don't allow state-regulated RIA firms to have solicitation agreements. We are a SEC-regulated firm, which means that we're governed by the federal law, which is technically the Investment Advisors Act of 1940. I'm not going to read this whole paragraph to you, but it's pretty straightforward. If you just take a screenshot of this or take a minute to read through this, it's pretty straightforward what the criteria is for abiding by these rules so that we can share management fees with you. Keep in mind that this can't be done with a broker-dealer. So broker-dealers are not going to carry this message to the agent community. And who's left to do that? And that is the RIA firms. Now, RIA firms, have reached a point in their, business life cycle where they've got enough assets and enough clients that they generate more business through referrals, and that's the way that the majority of RIA firms grow. So they don't necessarily do marketing, and what marketing they do is generally very local. We work with clients all over the country, and we've become adept at handling clients remotely, but yet still having that personal connection one-on-one. So I just wanted to make sure that that's clear. We do have that question come up in my conversations with agents occasionally. They're still quite surprised that they haven't heard of this, and I think that there's good reason why they haven't heard of it, and mainly because state RIAs may or may not be able to do it depending on state. Broker-dealers cannot do it. And that leaves RIA firms that are of big enough stature that they are SEC regulated who have the capability of doing this, but they may be of such a size that they don't care to market that way. So that leaves a void, I think, as to who carries this message out to the public. And if anybody has any questions about that, shoot me an email or we can schedule a call to talk about that. But, the other thing I wanted to talk about beyond that conversation is something that I hear fairly regularly, and that is talking about what is a fair distribution rate. We know that there is an academic conversation that's been going on for years and years about what they think is a reasonable distribution rate. And when I say distribution rate, I mean how much money can you take out of your retirement accounts and not have the account blow up after a certain period of time. So the academic consensus is that they think that number is about 4%. In fact, they call it the 4% rule. I've seen a number of white papers out recently challenging that the 4% is too high. And their rationale is that interest rates are very low. The 10-year Treasury is just over 2%. CD rates are very, very low, practically nothing. And because of that, they're challenging the validity of the 4% rule. The other aspect of that is the stock market just went through what they call the lost decade from 2000 to 2010, where it basically made little or nothing. So because of that, generating this 4% distribution each year has jeopardized some of these plans. If you pick apart some of the financial planning software, the 4% rule is a valid argument if you're investing in a traditional way and you have some allocation to the stock market. And the software does what they call a Monte Carlo simulation. And a Monte Carlo simulation means that they're taking random years for different types of holdings and just pulling a random calendar year and saying, okay, in this year, this was the performance. If you have this much of the portfolio allocated to this, in this random sampling, here's what the expected return would be for that particular year. So they would pull the performance for our domestic stock market, for international stocks, for large cap, for small cap, for bonds, and they would pull those all randomly from different years over the past 90 years. Because of that, they don't know in any particular year what year they're going to pull that number from. So they do this simulation about 10,000 times, which smooths out the outliers, and they can give you 90% probability under this scenario. The shortcoming of that software is it doesn't know that the very first year that you retire could be a year like 2008, where the S&P 500 was down 38%. If your portfolio is rocked in a year like that, where it loses 20, 30% or more, and it's early in the sequence, meaning that it's in the first 3 to 5 years of your retirement, that has a much, much more dramatic impact on the life expectancy of that portfolio than if that drop in value happened in the 35th to 40th year. Because in the 35th to 40th year of your retirement, you're much closer to the end and more than likely. And the impact of that is going to be diminished because of that. So a lot of it is just the timing of when those horrific, black swan markets can hit these portfolios. But the reality is, we don't know that it can't be the first year after retirement. And because of that, the portfolio could be devastated to a point where it fundamentally never recovers. So the argument is actually valid if you invest more traditionally, where you're in a buy and hold portfolio and you don't have any exit strategies, you don't have any way of protecting yourself from the bulk of these horrific market declines. But on the surface, we can challenge this 4% rule very simply. I mean, Rick, you know that you've got insurance products that we could tap into that could turn their retirement assets over into those products where they could guarantee a 6 or 7% lifetime income, depending on the age that they elect. I don't know if you have any that are even higher than that, but the fact that you can hand this off to an insurance company and the insurance company will guarantee you a payment of 6 or 7% for the rest of your life means that the 4% rule is, on the surface, completely invalid. But if the argument is talking about, more managed accounts, liquid investable accounts where you haven't, outsourced this to an insurance company for the protection that you get from that insurance company, then I think that, that debate still rages on. But it is a very different argument when you don't have these horrific market downturns, even in the years where the markets go down. We have a 14-year history on our equity model, and the worst single year in that 14 years that we've had was a drop of about 4.5%. And ironically, that was not even 2008. Our loss was less than that in 2008. Because of that, it's a complete game changer when you look at what the expected returns, expected distribution rate that you can take out of these accounts and yet have the account still survive. You would think that you could look at historical and say, okay, over the last 20 or 25 years, I've been putting money into my 401k plan. It's averaged 8%, it's averaged 10%, whatever the number is over that period of time. If that number is 8%, a lot of people would think that they could withdraw 8% each year and they would be fine. The problem is, if you're traditionally invested where you have one of these horrific market downturns early in the sequence, it could devastate the principal value of that portfolio to the point where it would not recover ever. And in effect, both wings are on fire and we're spiraling to our death. So, to give you an example, if you started out with a $100,000 retirement account and you were taking out 6% per year, that would be a $6,000 distribution. If that account in the first couple of years had a loss of 30%, your account value would go down to $70,000. That means that the $70,000 now has to generate the $6,000 distribution, which is closer to a 10% return, just because of the sequencing of when those losses hit the account. So the irony is, if it's kind of funny that if you talk to people about like a distribution rate, I think the safest thing for the life expectancy of the portfolio is to have a buffer of what you think that your portfolio is going to return and what you actually take out. So if you think that your average is going to be 8% and you take out 4%, that's a safer scenario than if you think it's going to average 8% and you take out 6%. So, if you had a client that was retiring with $1 million investment account, and he said, I need $100,000 a year, that's a 10% distribution rate. Even if you average 10% return on that portfolio, every year that it makes 10%, it's only making enough to match that distribution, and the $1 million never grows. And if there's ever a year where there's a downturn, you've begun to step on that treadmill, and it's just a matter of time. If you erode the principal at all, and you're still taking out $100,000, then you've started down that slippery slope to where that account's going to struggle to stay afloat. The irony is that, let's say that you had $1 million and you took out 10% a year, or you had $1 million and you took out 4% a year. Well, obviously, the 4% a year on $1 million would be $40,000 as opposed to $100,000. If you invested both of those accounts the same way, and they average 10% return per year, in the 16th year, your 4% income per year is higher than $100,000 because your principal value grows beyond the 4% that you're withdrawing. So we don't know how long people are going to live. I think that we're going to continue to push and challenge these mortality tables and longevity tables. And we want to be prepared for people to be able to pay their expenses if they're 110 years old or more. I don't like these plans that target a average life expectancy of 92 years, and we're having the conversation starting at 88 and 89 and 90 years old that we're right on target. We're going to be broke in 2 or 3 years, just like we planned to. That is not even if they die on time at 92 years old, that is not the way they want to live their last couple of years. Right. You want that account balance to continue to grow so that even if they do have the wherewithal to want to live beyond their average life expectancy, that they have the finances to pay the bills in that situation. If they don't live that long, unfortunately for them, we have achieved our financial goal, that we have paid their bills. If they die at 86 or 88 or 90, we have still met our financial challenge of being able to pay the expenses for as long as they've been alive. The problem is we don't know when they're going to die. And we have to err on the side of safety to keep those numbers going even when they're well past 100. So, that debate rages on. It's kind of, in most of the conversations, you don't have the time to really examine the contingencies like we have here with, an insurance product that can guarantee that amount. As opposed to a managed account, which may also go through the principal value by the end of the scenario, but it's certainly not guaranteed. So we think the best solution for people is to have a combination of the two. And studies have shown that people are far happier in retirement when they have at least a portion of their income that is guaranteed. Certainly Social Security is something that they rely heavily on and feel pretty confident that at least in their lifetime they're not going to see the end of Social Security. But, when it comes to these, withdrawals out of managed accounts, it relieves a lot of pressure if they have a certain portion of it that is guaranteed by an insurance company. And we fully understand that and endorse that strategy. It actually relieves a lot of pressure on us on the equity management side, because if we do have a slow year or a down year, it is not so critically important to the cash flow that they get on a monthly basis from that fixed product that guarantees them that income as long as they live. They can be a little bit more, brazen about handling the emotions of opening a statement where they have less money this month than they had last month. And they won't overreact to those little bit of volatilities that they might see in that account because they've got a certain portion of their income completely guaranteed. Right. So, that's a conversation I have over and over and over again with clients all the time. I think agents understand this because obviously they're plugged into the guaranteed income side of it. But I just want to make sure that agents understand that we completely respect that strategy and are fully supportive of that going forward. Right.
And each client is going to be different as far as you see some people say, hey, if they put me in the ground with my last dollar, then I've led a successful life. And then other people are going to say, well, I have kids, I have grandkids, I would like to leave some money behind to some people. So each situation is going to be different as far as how much lifetime income you might want expiring when your lifetime expires, or how much residual death benefit you might have in an insurance product, or how many assets you might still have in your managed account that can then be distributed on death. So each client is going to be different as far as what their goals and objectives are.
That's totally true. Yeah, as we say, the perfect retirement plan is where your check to the undertaker bounces. Then we've done this exactly right. And I tell people we can build the perfect retirement plan for you. We only need you to answer 3 questions. Number 1, what is your growth rate? And that growth rate could be interest, it could be appreciation, it could be dividends, it could be any number of ways that your account increases year over year. But whatever that rate is, tell me what that is on an average per year. Tell me what your inflation rate is going to be for the remainder of your lifetime. And then tell me the day that you're going to die. And the reality is that people can't answer any of those 3 questions. So I think the safest strategy in these distribution plans is to start with a reasonable, logical approach to how much you can take out. Build in as many safeguards and relief valves as you possibly can. And when I say that, I mean things like, okay, let's say that you had a horrible market occurrence within the first 3 years. If that happened, could you tighten your belt and keep your percentage distribution the same, but that might mean that you're reducing the actual amount of distribution that you take. So if your account value goes down to 90%, say, and you were taking out 6% of 100%, could you then take out 6% of 90%, which would be a lower number? That would be a reduction of distribution from 6,000 to 5,400. And a lot of people say that they could do that. That if that happened, if in a just a bad timing where the markets did poorly the first couple of years after they retire, that they would tighten their belt. And that tightening looks like, okay, you know what, we're not going to take that trip to Europe. We're going to wait on that until things look a little bit better. We're going to get one more year out of the car before we trade it in. We're going to cut back or hold off on those gifts that we were hoping to give the kids or the grandkids, until things look a little bit better. Those are ways that you can cut back. Other ways are you could say, you know what, I've been getting calls ever since I retired. People are asking me to work a day or two a week to do some consulting, depending on what occupation you have. Maybe I'll do a little bit of that. And that's a way to have a backstop and a safeguard that if something happens really bad in the early sequences. Probably the easiest one to have as a backup plan is to look at the value of your personal residence. If all of these things go horribly bad and you've completely burnt through all of your savings in retirement at 20 or 25 years, then the value of your home over that 20 or 25 years is probably going to double, depending on where you live in the country and what particular 20 or 25 years you look at. But even including the real estate meltdown in 2008-9, we still have roughly 4% average growth rate in personal residence values in this country. So very likely that value over that time period would double. Now you've got excess equity in your home that even in a worst case scenario, you could start to draw that out, and that might buy you another 15 or 20 years in retirement. The other issue that I see is that when you look at these mortality tables and you look at the average life expectancies, keep in mind that the way to get into that table is to actually die. So everybody that is counted is somebody that has already died, meaning that the person who died at 92 years old was born more than 92 years ago. People that were born more than 92 years ago lived a good portion of their life before they even had a polio vaccination. So we're going to keep pushing these longevity averages up. And the other factor there is that those tables are dramatically different depending on your economic status. If you're living in squalor, barely getting by from Social Security check to Social Security check and have no other income, your health care is probably not as good, your stress level is a lot higher, you may not want to live much longer. And the statistics certainly reflect that. If you have more than enough assets saved for retirement, you probably have access to better health care, you probably have the resources to pay for better health care, you're probably enjoying life more, you have a less stressful retirement, and you want to live longer. And I think that the statistics certainly prove that out. So, keep in mind in the last 100 years, we have expanded the average life expectancy in this country by more than 50%.
Well, hey, thanks for that, Tony. And there's obviously a number of factors we could take a look at, but let's wrap it up for today. Again, anybody who needs to know more about how to get involved with the program, go ahead and give us a call today, and we'll get you onto Tony's calendar so he can get you some more details and he can get you the solicitation agreement and some of the marketing material so you can start reaching out to your people. Thanks again for being with us, everybody. And until next time, this is Rick Geiler with SilverSide, and thanks for being with us, Tony.
Thanks, Rick. Talk to you soon.